Hi everyone, welcome to the Re7 podcast. Today we have Jane and Brian from zkLend. Welcome, guys.
Hi, Evgeny.
Thank you, Evgeny, for having us.
My pleasure. How are you guys doing in this summery DeFi winter?
Yeah, I guess the winter has stretched into the summer, but so far, I guess it's not too bad of a time for builders, as I guess we can hunker down and build and not be distracted by everything that's going on. Hard not to be distracted, but we keep telling ourselves, it's a great time to build.
Well, these are very, very wise words. So I think I agree with that. So could you please introduce yourselves and tell us how you got into crypto?
Yeah, I guess I will start. So hi everyone, I'm Jane, one of the co-founders and co-project leads of zkLend. And a little bit more, I guess, information about myself is after college, I took kind of the traditional path for a lot of econ majors, and I went into banking, but very quickly realized that I just felt different from a lot of people around me, and I just didn't really love what I was doing. It was okay, but I just didn't really feel very inspired by um, what it was that I was working on, and I just really dreaded thinking about spending the rest of my 20s doing that same job. So after 2 years, I feel like I paid my dues. I decided to move on to the Web2 space. So because I wanted to work at a startup, wanted to understand what it's like to work with young people, feel the energy, and really feel the impact of what you're building. So I had actually spent the majority of my career up until now in Web2, working at a food delivery company called Deliveroo. And I ended up loving it because obviously besides the people and the small group environment, I really got to see the impact of what I did. We really built the business, the food delivery business in Hong Kong from the ground up. So I went from like in 2015, seeing almost like online food delivery platforms not exist to seeing it during the pandemic to become one of the most important parts of any F&B business. So for me, that was one of the most rewarding parts of my career. But I guess after a couple of years, you always feel like there's a need for a change. So, I've always been quite interested in investing in crypto on the side, but never really seriously looked at it until I guess early last year when I started using some of the Web3 protocols, and I met a couple of people in the space, and met Brian as well as zkLend, our other co-founder, and we just clicked right away. So that's why I'm here. And sorry, it's a long story, but excited to share a little bit more about the protocol with you.
Cool. Well,
Thank you,
I have to say that I'm probably one of the most loyal users of Deliveroo. So thanks for building that.
Yeah.
Yeah, Brian, over to you.
Sure, of course. Hi, everyone. It's Brian here. I'm also one of the co-founder, co-project leads of zkLend. Before starting zkLend, I actually worked in the financial industry for about 15 years. Right after graduation, I started off in investment banking. It was an interesting time at the end of 2020s and starting 2010 forward with a lot of the IPOs and bond issuance in Hong Kong, especially cover the Greater China real estate sectors. Did a lot of bonds and transactions and private equities and also private debts, and did that for about 6 years before moving on to private equity sides, pretty much doing the same thing, but switching sides of the table, doing investments and doing a bit of leverage buy out. So with all these experience I have worked as a lender and a borrower in both sense, and in a traditional institutional setting. And then starting in around 2017, and then got crypto pilled and starting to look into a lot of DeFi protocols, but it's more so on a side retail investment and just kind of speculating and think of it as more of a just hold and wait for it to pump kind of situations. So it was until later part of around 2018 when the whole DeFi started to boom, and I see a lot of protocols doing a lot of fancy stuff, a lot of very interesting stuff that's having a lot of touch point, not just on the institutional space, on retail, but basically open up to all the banks across the globe. And that's when I think that basically there's a lot of potential here that's not being tapped, and basically just open another horizon for me. So really wanted to get involved in the space professionally, and it was towards the mid of last year when I got the opportunity to connect with Jane and our CTO, and the idea of building a money market protocol or similar to a decentralized bank on chain really excites me, and I pretty much got dragged away and couldn't think of anything else but to do this thing full time. So by end of this year, got together with the three of us and then also some of the other founding team members, and just start building on StartNet. And I'm happy to go into a little bit more on why we built on StartNet later on, but that's a quick and dirty summary of my background and why I moved over from the TradFi space.
That's that's very cool, and in many ways similar to how I left traditional finance and also jumped into DeFi. So tell us, what is zkLend? What is the mission? Why does it need to exist?
Yeah, I can take this one. So I guess breaking it down to a couple of pieces. On the very, very basic level, zkLend is a lending protocol built on Web3. And users are able to, well, I guess we have two products. We have Artemis and Apollo. So starting with Artemis, it's a decentralized protocol that that anyone could borrow and lend and using the protocol. So let's just say you have a bunch of ETH that you would like to earn passive yield, you would be able to deposit into the protocol. Or if you would like to borrow a bunch of wrapped BTC, you would be able to do so on the Artemis protocol permissionlessly. Our other product, Apollo, is slightly different. It is our institutional product, and that's really targeting, I guess, as I said, institutions like banks, prop shops, trading firms that may actually care a bit more about things like compliance and KYC requirements. So it differs from Artemis in a sense that not all users would be able to borrow through this protocol. It requires some form of whitelisting. And so the idea is, these institutions, so to speak, would be able to enter the protocol and either borrow from other whitelisted institutions or potentially from other retail users under collateralized. And yeah, sorry, go ahead.
Yeah, there are obviously quite a few lending protocols in DeFi already. So what was your motivation to introduce a new one and to do things differently, I guess?
Sure,
Yeah.
I can talk a little bit more on this one.
Yeah.
Sure. So for us, the idea of building a money market protocol, it's not something that's new or something that's totally revolutionary. There are Aave, Compound, Cream, and so forth in the market that has been existing for quite some time, and also there are other agnostic lending borrowing platform as well. For us, because we have two main theses on building this protocol. One is that we want to build on a layer two that's using the Ethereum network as the point of security, the point of decentralization. And another one is that we want to incorporate the institutional aspect into the whole lending protocol, such that we have both Artemis and Apollo bunched together into one single protocol. The idea of it is we see a lot of money market protocol there operating on a decentralized format, yes, and they can do a lot of lendings over collateralized, and that's all very well operated and has been going on very, very strongly. But there's still a gap in terms of how the capital efficiency can be improved, and that's when we see the opportunity of one using layer 2 StartNet to help us increase speed and lowering our costs for the DeFi side, and also for the institutional side. It's we still feel that there is a need for a protocol to be built with the proper compliance in terms of AML and CFT, and also sanction party, as well as the on-chain whitelisting component, for example, tracking their wallet activity and so forth, such that we have a compliance version of the lending protocols where the DeFi and the institutional side can actually bunch together, and so that the institutional can also lend to whitelisted retail. And in that case, we will be able to increase the tool pool, break down the fractioning and the fractioning of the capital pool, and then making the capital efficiency a lot higher than what is already being established on chain.
That's very interesting. So if we talk about the institutional product for a second, right? So why do institutions need Apollo? They could obviously just go to traditional banks or prime brokers and get loans there. So what is kind of the killer app here that will drive them towards zkLend?
Yeah, I can speak a little bit more on the institutional side, and I think Jane can add in on how the retail can actually tap into the institutional too. But for, let's say, for institutional users, we see that the native, for example, the native crypto native funds traders, obviously, they have a lot of crypto holdings, one of which they could be on holding without actual usage at the moment. So these could actually help them to gain leverage on it and be able to use it for passive income, one, and also to get other currency so that they can use that for hedging, for speculations, or for other yield farming purposes. That's one. And two, it's we see that a lot of the smaller corporates or even SMEs, they do have crypto holdings at centralized exchange at the moment, whether that be for speculation purpose or not. They don't have a really good use for it, and we feel that we want to be the gateway so that they can diverge from using a centralized finance or CDFI approach, and then really using Apollo to go into the decentralized world and being able to interact with DeFi users. And one thing that the bank cannot support is one, a lot of the, let's say, the lender on the other side, they would not be able to incorporate any of the retail users for one. And banks, basically, they are the only custodian, or they are the only controller in terms of the lending market, so that the pricing, the structure are pretty much quite standard, so that a lot of the banks, they make the price, they make the structure, and borrowers just have to accept this and accept the pricing as is. But for Apollo, we have the structure of setting your own borrowing pool. And with that, you will be able to set up a lot of your, in terms of whether you want it to be revolving, whether you want it to be short-term, long-term, how your interest rate is going to be, and your utilization of the pool. All these are controlled by the user themselves. And the flexibility, it's something that will not be able to provide by a centralized financial institutes.
That makes a lot of sense. And it sounds like it would be some sort of a very efficient bridge between the traditional finance and decentralized finance, because obviously right now they're operating complete silos. So such a kind of compromise solution, I guess, gets us the best of both worlds.
Yeah, I think one thing to add here is Brian and I are very conscious that we're still very, very early. So oftentimes, if we're talking about whitelisted institutions, we may still be range bound to a lot of crypto or crypto like savvy companies. But I think in the long term, what like the success of protocols like Artemis would be able to prove is that institutions, or like, and we're not just talking about financial institutions, the JP Morgans, the Goldman Sachses of the world, but like businesses don't necessarily need to go to the bank to take out loans. Like they could do this through Web3, and it could be done through kind of crowdsourced funding, because ultimately, funds of Apollo are coming from other depositors, and depositors would have full transparency over what is being lent out. And I think that is just the most valuable part of Web3 and having everything on chain.
I agree. That makes sense. We already have seen some successful case studies, so that use case clearly has value.
Yeah.
And if we talk about the kind of the other part of your protocol that will be competing with Aave, Compound, and others, so Artemis, what is my understanding is that it will be very heavily focused on smarter and more efficient risk management, which I guess is even more valuable given what happened in the market over the last couple of months. So I'll be curious to learn how you guys think about risk management from a perspective of protocol and a perspective of someone who would be using your protocol, and if that thinking has changed given the latest events.
Yeah, that is a big question. So I think we can break it down into a couple of pieces. But I can start out with a couple of ideas that are central to our protocol and kind of the things that we really flag out to our retail users as to why we stand out. Ultimately, I think the headline of what we're trying to establish is that we are trying to be the money market protocol on Starknet, and we want to, given that it is a very nascent ecosystem, we want to be kind of the lubricant of different activities on Starknet, and specifically because it's shaping up to be such a gaming focused ecosystem, we want to be kind of the, what do you call that? We want to be the financial Legos that enable people to thrive within the ecosystem. But specifically, I think our protocol kind of differs from others in that we really focus on risk management. And a couple of components here that I want to flag is we have adaptive interest rate curves, Eurobor's model, I'll explain some of them in a bit, a double-sided collateral factor, and a very flexible liquidation mechanism. In terms of adaptive interest rates, without going into too much detail, what I mean by this is oftentimes the way that when you deposit money into our protocol, how do you figure out how much interest rate you're earning, right? And how do I figure out how much the borrower should be paying in interest rate for the asset that they're borrowing? It's based on two curves. And these two curves are determined by the utilization of the pool. So let's just say the pool has 100 ETH, right? Because people, let's just say collectively 100 people each deposited 1 ETH into the pool. Now, someone might come in and they might deposit 10 BTC and they use it as collateral to borrow 50 ETH. Let's just say that one person borrows 50 ETH. Now that pool's utilization is at 50%. Okay, let's just say 5 days later, someone comes in, deposits some kind of collateral like USDC, and comes in and borrows another 25 ETH. Now the pool is up to a 75% utilization. At that point, the interest rate in which the depositors earn will be higher than when the utilization rate is at 50%. And the borrower will also have to pay a higher interest rate because the utilization is higher. So this is kind of how interest rates work. But right now, the model of different money market protocols like Aave and Compound are based on two different slopes with a kink. And the reason why is we're all solving for an optimal utilization. Let's just say 70%. So, the interest rate increases up until the 70% utilization. And then suddenly the curve steepens like crazy. Like, let's just say the slope of the curve goes from like 1 to like 5. And the idea of that is to discourage people from borrowing after the utilization hits 70%, just so there's enough liquidity in the pools, but also because there might not be enough money in the pools for people to borrow. Now, that's great and all in theory, but what it doesn't solve for is it doesn't solve for a good user experience. Because imagine if the utilization rate always fluctuates between 69 and 71%. The variable rate that someone pays at 69% is drastically different than when someone pays at 71%. And this could be the difference of like a couple $100,000 in the pool. And so for us, we really want to smoothen out this experience, and we want to make sure that the curve is, the slope of the curve continuously changes rather than has two slopes that we're solving for. So this is why we are introducing adaptive interest rates to make sure that the experience is smoothed out, but still maintaining the fact that as utilization increases, the interest rate will also increase to kind of slow down the deposits. I'll pause right here to see if there are any questions before I move on to the next one.
That's a lot to digest. But as a very active DeFi user, I feel this pain all the time, because we as a fund would go and we would deposit stable coins or whatever else and potentially borrow, and then we have to build automated real-time alerting system, because theoretically utilization can go past a certain level, and then your borrowing rate spikes by a magnitude of multiple times, which is obviously not the right way to manage a lending platform. So I totally get this, and I think that makes a lot of sense. With regards to liquidations, how in general have liquidations worked so far in DeFi, especially again in the context of the latest events, and what can you do to make them even better?
Yeah. So Brian, please feel free if I jumped, if I missed anything. But I would say right now liquidations are a problem on layer one, because let's just say there is a position that needs to be liquidated. Oftentimes protocols need to incentivize liquidators enough so that it is profitable for the liquidators to come in. But this comes at a cost for borrowers. And what I mean by that is there's this thing called the close factor, and that is how much percentage of a user's loan position can be liquidated. And so let's just say, Evgeny, you borrow 100 ETH, and suddenly you are at risk of liquidation. Suddenly a liquidator could liquidate up to 50%, 50 ETH of your position, even though you might just be underwater by just a little bit. And the reason for that is it is to incentivize liquidators to, I don't know, either compensate for gas or some sort of slippage cost for some of the less liquid assets. For us, I would say we are quite focused on the liquidation mechanism as a result of layer twos and what it enables us to do. Because gas fees are so low and transaction speed is pretty high on L2, we're able to actually design a liquidation mechanism that doesn't penalize borrowers to make them kind of lose up to 50% of their loan position. Rather, we aim to liquidate just enough so that they just go above water and they maintain a health factor of slightly above 1. And liquidations don't necessarily need to be done by one I guess liquidator per se, right? It can be done by multiple liquidators at different points in time. And I think it's the cadence of that differentiates us from, let's just say, more traditional money market protocols with more rigid liquidation mechanisms. And I think one thing I really want to stress is, the events of the crypto kind of crash in May has kind of opened our eyes to a lot of things. I think while we are still very confident with our liquidation mechanism, there are a lot of more considerations that come into play, not just for us, but for the whole industry. So take zkLend, for example, right? I remember that position of the whale that I think it was like 200 something million worth of zk that would be liquidated. I think the implications is humongous, right? Number one, you need to find the liquidators that will liquidate, but also like the slippage of having to liquidate $200+ million worth of zk on the market is going to be huge. So as more liquidators are coming in to liquidate these positions, the slippage might go higher and higher. And also the impact on price could also be higher on an asset, which kind of causes a lot of market disruption, which is not something that I guess any money market protocol aims for. So I think there are a lot of lessons to be learned from the zkLend episode, right? I think number one, it's what is the protocol's role in ensuring, these huge positions or huge liquidation positions don't happen? Or number two, if they do, how do they manage that? One of the solutions that zkLend had presented was, they might take over, the loan position of the borrower and potentially do an OTC deal. And that proposal was quickly rejected by the rest of the community. But I think it poses a more important question, which is then, how do we manage this, right? Do we manage this by limiting borrower positions so that there isn't a whale that could like disrupt the market like that? Or do we look at different, I guess, liquidation mechanisms that could smoothen out some of this liquidation? And I think there's still a lot of questions to be answered, and very tough questions to be answered. But these are things that we are also actively looking at.
So
Yeah,
that's actually Oh, sorry, go ahead.
Sorry about that, Evgeny. Just to one point to add on to Jane's point, it's for layer one. She mentioned that there's a close factor where, for example, position up to 30 or for 50% could be liquidated at one time, and that's primarily due to the cost consideration for liquidations. And for each of them, for example, if you have to liquidate 30 to 50%, how it currently works with the liquidation discount is that because all these positions are over collateralized, you have a fixed liquidation discount to incentivize liquidation bots or liquidators to come in to help and move the position up and basically return the loan and then get the collateral at a cheaper rate. What if, for example, what we see is that, especially in this market, the reason you would have liquidations happening at a very, very high frequency is when the market is very, very choppy, like what we see a month ago. And especially during that case, it's the liquidation discount itself. It's not be able especially what Jane mentioned. It's the zkLend episode. It's the slippage itself is actually higher than the liquidation discount already. And what actually is a core differentiating factor for us for using layer 2 startnet, it's we can actually break these liquidations apart from, for example, up to 30 or 50% into tiny pieces. For example, just liquidate 2 to 5% or 5 to 10%. And what it does is for each of these little liquidations, they can have different liquidation discount. And so basically what it means is you would be able to adjust how the market reacts and how adjust that to the slippage of the AMM and how it actually goes, and be able to incentivize liquidation this way. And so that it would be a lot more flexible, a lot more robust, and you would have basically user experience would be a lot better because you won't be either stuck with one situation or stuck with one position and unable to liquidate it, or being liquidated at a high discount at a high proportion of it. So I think this is something that we feel it's not a core a selling point in terms of the lending, normal case lending and borrowing operations, but things that we feel it's a core user experience, and we don't see it very often. But when these things happen, it really causes severe impacts to the users.
That's I think everything you highlighted is a very important kind of case study of how, not only do we go through this latest painful cycle as an industry, but also what awaits and the challenges. Because yes, indeed, because liquidity is fragmented across different chains, liquidations are becoming a harder problem to manage. And I'm curious, the example of zkLend that you mentioned, which is, I think, a very interesting one. How do you think about the role of the protocol, and what is the fair way of solving such a problem?
I can take a first step first.
Yeah.
My personal opinion is currently what they propose right now, I think given the whole situations, that I do think their risk mitigants and mechanisms are set in place, and they are fair and diligent, but it's just the market itself and having, for example, such a high concentration for a well position that's causing an issue, and that's comparing to the underlying Solana token itself. So some of the lessons learned we can take from that is one, I think being able, like I mentioned just now earlier, being able to break down the liquidations into the smaller pieces and at different liquidation discount to incentivizes could help. And another one is basically to set control as to how much of a single lender or single wallet it's able to contribute to lend or to borrow from a single pool, because ultimately that's it also depend on how this position compared to the entire market cap of the token itself, and whether that would cause, for example, a liquid situations or actual price movement such that the slippage would increase as you have liquidations going on for that single position. So I will stop here, and then I'll let Jane to highlight any other point as well.
No, I think that was good. It just got me thinking about another point, but it got me also thinking about governance, which is around, I guess, like decentralization and censorship resistance, which is that, there was a lot of backlash around the initial proposal by zkLend, which had actually passed, and the team actually hadn't voted on it, but there was a particular wallet address that had a lot of votes because they obviously had a lot of tokens. And they voted to, for the zkLend team to overtake the borrower's position. And I think it poses a very interesting case study also on, sorry to deviate, but on like DAO structures and how voting rights should go, because, how do we, I don't know, I don't want to use the word prevent, but how do we kind of balance out the whales and their voting power from, other people that are a part of the protocol and should get an equal voice?
That's a very tricky question, because then,
Yeah.
when you start limiting people's voices, then suddenly it's, it's kind of no longer democracy. But yeah, governance is a very important piece here. And yeah, there are clearly lots of important questions that need to be ironed out. And if we zoom out, so you mentioned that you made the decision to build on Starknet, and you also mentioned it's interesting enough, kind of a gaming heavy ecosystem. So I think this is probably going to be the first lending protocol on Starknet, unless I've missed something. But you guys are really kind of paving the way. So I think a lot of our listeners could be interested to learn more about Starknet in terms of what it is and how it works, and why is it a great thing to build on.
Yeah, I can take a stab at this one. And Brian, I think where you're really strong at is you can tell people a little bit more about modular blockchain and what are some of the benefits. I'll start with Starknet. So for those of you who are maybe not super familiar with it, Starknet is a public network developed by the Starkware team, and it sits on layer 2 Ethereum. And so what that means is it inherits a lot of the security and decentralization. Well, let's just start with security of Ethereum, but at a fraction of the cost and at a much quicker speed. So what happens is, I like to use the analogy of like an Uber and a bus ride, which is like, if you're transacting on Ethereum layer 1, you're kind of like taking an Uber. Taking an Uber to get to work, it costs you maybe like $20 and like 50 minutes because traffic is like crazy in the morning, and then you can't get there and it's super inefficient. And then you have the likes of layer 2s, and I think of them as like a bus. The bus that picks you up on the same spot where you grab a taxi, but there's a high, what do you call it, HOV lanes, like high occupancy lanes, that gets you there maybe like twice as fast because there's a lane that's exclusively made for buses. And but the bus is packed. So it bundles all the transactions together and it sends it to layer 1. So rather than having to send transaction by transaction, all of them are bundled and packed into a proof. And so these proofs are done mathematically by the Starknet team, or potentially decentralized provers. But what it really means is, you get to enjoy a lot of the benefits of Ethereum while living on layer 2. And maybe a little bit more context on, how you build on Starknet and such is, Starknet is not yet EVM compatible. So to build any protocols on Starknet, you do need to write everything in Cairo. But that being said, there is a transpiler that was developed by Nethermind to transpile Solidity code into Cairo. And so I think the good thing about that is because Starknet is not EVM compatible, what it does is it also enables a lot more, or enables certain things that you can't do on EVM compatible chains that you can do on Starknet, which is why a lot of gaming protocols are coming into Starknet and trying to build new things, because of the number of computations that can be done, and because they can push more the boundaries of the different things that can be built.
And I would like to talk a little bit more on, Jane mentioned Cairo, and it's an excellent segue for me to talk maybe 2 minutes on the mechanism of it. So Cairo, what it is, it's a programming language developed by Starkware team specifically for the zero knowledge proof applications. And what it does, it means that all business logic can be written in Cairo, and when it goes through a prover, and which is called Spark, when it goes to a prover, it will generate a proof that every single time you will be able to generate a proof that's going to be using zero knowledge proof and be able to prove back the input and output, and every single time you can check it. And the benefit of it is once a code is being proved, and so you can send that proof to you can check that proof on layer 2 and then send a proof on layer 1, and every single time you generate the proof already, the checking of it actually it's going to be a log a logarithmic scale of what it used to in terms of the time it takes for it to generate the proof. So in cases like, for example, if you compare a y equals x versus y equals log x curve, as you go further out in terms of the complexity of the steps and complexity of the computations of the program, the magnitude of time saved is actually going to be exponentially higher. So that's one. And on top of that, StartNet is able to impose itself with a recursion mechanism. And what it means is that the proof being generated by the prover can also be going into another proof to generate another proof for the validator. So on top of what you have, for example, a log scale of the time it takes to check the proof, now you can bundle that, and then being able to, in Gene's analogy, basically pack the bus with as much proof as you can instead of having just one single code in one single vehicle. And this basically means, for example, for each cost you have for the one single transaction, you can split it across multiple, and then the higher limit you go in terms of how many batches you put together in terms of transactions. Basically the gas fees would be separated into all these batches, and that's how you get the lower gas cost as well. And the last component that the recursion is able to create is a layer 2 and layer 3 structure, as well as hyperscaling structure. And that's especially applicable to institutional user because what you have is, for example, we are using layer 2 for Artemis, and that it's a general public StartNet ecosystem. And what we can do is we can have proprietary or control or private StartNet for institutions or a pool of institutional users to interact on a layer 3, and their proofs being ported over to layer 2 to be validated, and then going back to layer 1. So what it means is you will have much higher speed control on transactions, and also in terms of transparency of the transactions, the privacy of the transactions, all bundled together at layer 3 and without losing all the benefits of layer 2. So this is something that's really pushing the boundary of what the application can be for money market protocol, and we are still experimenting with a lot of the features and exploring it.
This is very interesting. Is it harder to build as a team? Is it harder to build on StartNet than just on L1?
Definitely. From what we understand, our own experience is that because StartNet is very nascent in its own development, and the whole, I mean, even for our team, we start building on it to around early this year. A lot of the toolings are not available as opposed to, for example, if you're building on Solana or Solidity or Rust Solidity, and because these toolings, if you want to use them, there are no libraries available just yet. And if you want to do certain operations, for example, just simple mathematics, you have to do these code and do these toolings yourself, as well as some of the hooks on APIs and the technicality of the channeling and bridging. So these are some of the core challenges that the ecosystem, every builder is experiencing as a fresh and nascent ecosystem. But overall, everyone is very active in the ecosystem and very upfront into building out the toolings, building out all the infrastructure, so that right now the situation it's a lot better, and there's still a lot of ways to improve, a lot of ways to go, and I would say one thing I noticed is the creativity. It's not bound by what it's already built, as opposed to, for example, if you are in layer one Ethereum or other layer one blockchain, and because what the Cairo enabled all the builders to do, they are taking it to a different tangent, and in terms of storage, in terms of latency reduction, all these there's no boundary as to how it could further improve on top of the current structure.
And from a user perspective, is it better or worse? Like, what's the obviously this? It sounds like Stark has some very serious technical advantages, right? But it's harder to build on. But from a user perspective, is there additional pain associated with this, or is it a smooth experience?
So I think it's a mixed bag. If we look at kind of the infrastructure of Starknet, there's a lot of native protocols that are building in terms of like bridges, in terms of wallets. There's Argent X as a wallet, and there's also Pontus and Stork as price oracles. I think, to be very frank, these are obviously up and coming names, but they're probably not as recognized as the MetaMask, the Chainlinks of the world, which does make it a little bit more difficult for users to get accustomed to, right? I'm a big MetaMask wallet user, so when I use Starknet, I do have to download Argent X, and that's not to say it's not a great wallet, but it does require a little bit more adjustment. But I think I think it would be a little bit short-sighted to say the user experience of Starknet is not great, and that's why I'm not using it. But rather, you kind of think of it as part of the growing pain. As the network scales, like these things will naturally smooth out because more and more people will come onto it. There'll be enough demand. Whether people, all find the Argent X experience really great or they adopt it, or MetaMask does come onto Starknet. But I think more importantly, the focus is really on the value of the ecosystem and the types of things being built. And I think, as Brian alluded to, the innovation that comes along with the protocols and like specifically one of the examples I like to give in terms of the gaming world is, don't get me wrong, I like games, and but a lot of times, play to earn games are not economically sustainable in my mind because question around, do people really enjoy these games? Frankly, would gamers pay for these games, especially around these NFTs or characters? I think it poses a really big question that I don't think the industry has an answer for yet, or it's avoiding. So, a lot of these Starknet gamers are very serious gamers that really care about the gaming experience and not about monetizing off of it. They've created like realms, like different realms. Talking about like on-chain like music generation. I don't even remember what it was called, but it was like if you enter into a different world, there will be different types of generative music that comes in to enhance your experience, because a big part of games is music, and currently it does not exist on the blockchain. So I think there are some very interesting things going on, and I'm still like learning so much of it myself. But I think that's what makes the ecosystem so I don't know, so promising.
That's very interesting. Music use case, actually, that's a very good one, because I was recently just thinking, there is no kind of rich media on the blockchain, right? Whether it's music or movies or whatever else, and that could definitely be an interesting use case. So
Yeah.
we have just a few minutes left. So if you summarize your journey so far, how has it been for you? Where are you in the journey now as a zkLend team, and what's next for you guys?
Okay, I can take a stab at this one. So, we started building back we got the team together late last year, and we went around fundraising back in February, and we really started building at the same time. So our roadmap was really around building Artemis first, because number one, we felt that it's a more mature market, because ultimately, you could have a great product, but if the market's not ready for it, it's not ready for it. And we felt that in terms of knowledge and user base, Artemis as a permissionless protocol would be slightly easier for users to adjust to and adapt to first. So we have actually just launched our MVP testnet. It's a closed testnet for whitelisted users, but it basically encompasses some of our most basic contracts as well as UX and UI features of the protocol. The idea is, after this launch, we will collect feedback from our key users, such as ecosystem folks, developers, as well as some of our investors to enhance the protocol and ready it for mainnet launch in late September. We are quite lucky because, well, I don't know if it's lucky or unlucky, but, Starknet is not really ready yet. The mainnet is out, but there is a cap on the amount of assets you're able to bridge over, as well as the quantity of assets you're able to bridge over. So most of the protocols are not yet on mainnet. So this actually gives us a good amount of time to really enhance our testnet further before Starknet mainnet really launches, and for our mainnet to go on Starknet. After that, we are looking to build out Apollo. Apollo is slightly different in that it is targeting institutions. So rather than having a marketing strategy that is more around educating the community and a slightly more one-size-fits-all approach, Apollo will be very, very tailored to the institutions that we onboard. But ultimately, the idea is we want to be known as zkLend. We want to be known as kind of the one-stop shop where people could look at, okay, I want to deposit my ETH. Do I want to lend to over-collateralized users on Artemis, or do I want to lend to under-collateralized users, which are institutions, with a full knowledge of who these people are and what happens on chain? And that's really our goal to our goal is really to kind of continue and not reinvent the parts of finance that really works, but to kind of build on top of it and really promote decentralization. So I hope that answers your question. Brian, feel free to add. Yeah.
I think it does, and yeah, Brian, please jump in with your thoughts as well.
I was just saying that for that's Jane summarized it very, 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 very well already. And for us, once we have Artemis launch, our core focus will be on Apollo, because we feel that our protocol is not just one arm on Artemis, and then Apollo is going to be a side product. Two products are going to be equivalent, and they would have synergies on each other. So a lot of what Apollo entails, it's us actually going to institutions and being able to strike a strategic partnership with them in terms of having them to be our launch partner, having them to be a supporter and key users, and being able to open a borrowing pool within a protocol. And ultimately, that also includes basically drawing in different parts of the ecosystem. For example, we know partners that are doing something similar to a credit score, on-chain KYC component, and all these compliance related features. So these are not currently available on any of the blockchain system just yet. But I think what we're seeing is that because CeFi has been suffering, and a lot of people are actually looking into DeFi and see how there could be a good analog between the two, and a good bridging between the two, while we can still have the decentralized financial principle, but being able to do it in a compliant manner. So this will be our next focus after Artemis.
That's very interesting. And I guess as a final question, so we're in a bear market now. Does this in any way change your passionate approach to what you're doing? And obviously, I know the answer to that is no. But how do you think about DeFi and for the foreseeable future? As in, has this scared off a lot of users, and will DeFi need to reinvent itself? And in the context of zkLend, have you changed your roadmap in any way? And if so, how?
Sure, I can take this. Three things we picked up from this bear market, or what has happened in the whole DeFi CeFi analogy. It's For one, we feel that for us, basically the plan did not change. You mentioned it right already. We are very focused on building. One thing we actually notice is because we see that a lot of investors actually have been on a de-risking mode. So one, it's we start to see a lot less noise in the market, and we can really focus on building and really focusing on striking strategic partnership with guys that are actually not here to try to make a gain, but actually doing some great things to build out the ecosystem and really try to push for the Web3 or DeFi mass adoptions. And for us too, it's a lot of what we don't see in a good market actually comes out and show its true self in the bear market. And for us building in a bear market, we actually have a very good reference point as to what could some of the features or some of the mechanism leads to, or some of the the design decisions that we have, what will be the repercussion of it, and that actually puts us back and really have to think about our credit management system, credit enhancement and mitigation mechanism to make sure that we have all these thought out and not just relying on users to do their own research and pushing off the risk to the users themselves. That's two. And the last piece, it's basically for us in terms of us coming out to the market. I think for us, our initial goal is to have our product out, and in terms of having tokens or anything like that, the TGE, these are all going to be supporting events for our protocol running. And the main thing for us is to ship the product out and have the product providing a good experience for the users, and token being a side addition to some of the utilization in terms of governance and also the distribution rewards. So at a relatively depressed market right now, I think overall, two things. It's the interest rate expectation, it's much more reasonable now. And a lot of speculators have actually got out of the market. And whoever's still investing right now, it's actually in for the long term. And so all the interests are aligned, and we don't have a lot of pressure to really chase or really give out high incentives to get people to attract all these mercenary capital to come in. So that's a really good thing for us. And in terms of TGE, I think basically it actually puts us in a really good form where we are launching in a neutral market or slightly uprising market, so that there are still a lot of rooms for value accretion for our tokens and for our protocol. I think all these, I would say it's pointing to the right direction. And for us, it's just focus on building great product, and then all the things will come afterwards.
Wise words. The future is truly bright, I think, when it comes to DeFi. And as long as people can keep building, then I think we'll be okay. So thank you, Brian. Thank you, Jane, for making the time, for joining the podcast, and for sharing with us what the future of DeFi holds. So with that, I wish you luck with everything you're building, and looking forward to keeping an eye on your social media to see when launch.
Thanks, Evgeny. Really appreciate the platform, and talk to you soon.
Thank you.
Thank you. Good luck.
Much appreciated. Thank you.